Let's talk about one of those wild days on Wall Street where a single headline comes out and flips the entire market on its head. We're going to break down how two of the biggest names in market commentary watched the exact same thing happen and walked away with two completely different game plans.
So, what do you do when the entire market narrative, the whole story, just gets rewritten in a matter of minutes? That is the big question we are tackling today. Let's dive right in.
All right, so to really get this, you have to understand the mood before the headline dropped. And the mood was tense. The market had been looking pretty weak, and it was sitting right on a critical technical level that had pretty much every trader holding their breath.
And that critical level was the 200-day moving average. Now, if you follow the markets, you know this is a huge deal. It's basically the line in the sand. For days, the Nasdaq had just been staring into the abyss of decline. The bulls and the bears were in an all-out war right there, and nobody knew who was going to win.
And here's the kicker. This wasn't the first time the market tried to find its footing. It had attempted to rally before, get some momentum going. But every single attempt just fizzled out. Confidence was shot. The whole market just felt incredibly fragile, like it was waiting for one little push to send it one way or the other.
And then, bam, it got the push it was waiting for, a massive one. One single geopolitical headline hits the newswires, and just like that, the entire dynamic of the day and maybe the week just completely changed.
Let's paint the picture. The morning starts, and it is ugly. The Russell 2000, which is our go-to index for smaller companies, was down a nasty 2.5%. The selling was on, and it really looked like that 200-day moving average was about to snap.
And then, this one quote changes everything. A statement that the conflict with Iran could be ending soon. That was the spark. That was the one piece of news that took a market bleeding red and turned it into a tidal wave of green.
And the effect was, it was instantaneous and it was dramatic. You have to remember, the threat of war had oil prices just screaming higher. This news, it sent them into a free fall. We're talking from around $120 a barrel all the way down to just 87 in one single day. For the stock market, that kind of drop in energy costs is like a pure shot of adrenaline.
Okay, so the market pulls this incredible U-turn. The question on everyone's mind is, what do we do now? Is this for real? Is this a bottom? Or is it just a head fake we're all going to regret? Well, two of the biggest voices out there, IBD and Mad Money, looked at the exact same picture and came up with two totally different roadmaps.
And this slide right here, this is where you really see the two schools of thought clash. It's fantastic. In one corner, you've got IBD, the cautious technician. They're all about the rules. For them, today is just day one of a potential rally. They're not jumping in. Nope. They need to see more proof, what they famously call a follow-through day, and the market absolutely has to stay above that 200-day average. But then you look at the other side, Mad Money, the thematic opportunist. They're saying, whoa, the whole game just changed. For them, it's time to get back in, cautiously, because that huge AI theme that was getting choked by high oil prices, it's suddenly back on the menu. But, and this is a huge but, it's all conditional on geopolitics staying quiet.
Okay, so that's the high-level philosophy, right? But what does it actually mean for a trader? Let's break down how these two clashing viewpoints turned into real, actionable ideas you could actually put money on.
IBD's playbook is pure old-school technical analysis. It is all about the charts. They're not chasing stories, they're looking for textbook setups. They're pointing to stocks like Teradyne, which came down and bounced perfectly off its 50-day moving average. Or check out Caterpillar, finding a floor at its 10-week line for the third time. See, for them, it's all about playing the percentages. They let the chart tell them when the risk is finally worth it.
Now flip over to Mad Money's playbook, and it's like a different universe. They're not worried about a 50-day moving average. It is all about the theme, the story, the catalyst. They're laser-focused on a name like Oracle, right? Ticker ORCL. Why? Because it's a monster in the data center world and has huge earnings just around the corner. Then there's Vertiv, VRT. Same theme, but with a different kicker. It's getting added to the S&P 500. You know what that means? Billions of dollars in index funds have to buy it. It's about skating to where the puck is going.
But here is the most important part of this whole thing. And honestly, it doesn't matter which camp you're in. This is what separates the pros from the amateurs. Both of them, despite their totally different approaches, were absolutely crystal clear on one thing. You have to know when you're wrong. You need an escape hatch. Let's call them what they are. These are the kill switches, the get-me-out-now signals. And look, they both agree on the big one. If that geopolitical story goes south and oil rips back over $100, the party's over for everyone. but their individual tripwires are different. For IBD, the purist, it's simple. A close below that 200-day moving average on the NASDAQ, and they're out. The setup is broken. For Mad Money, it's a bit more nuanced. If oil can't even stay below $90 for more than a few days, it tells them the headwind is back. The AI theme is dead in the water, and it's time to pack it in.
So where does that leave us? You've got one massive event and two completely logical, yet totally opposite playbooks. It really makes you think, doesn't it? In a world where one headline can change absolutely everything, maybe the real secret isn't finding the perfect way in, but knowing exactly where your exit is. Is the true edge in the setup, or is it all about the exit plan?